Now, in this video, we'll look at Level 3 under Study Session 17, Risk Management Applications of Derivatives. So reading 32 is on Risk Management Applications of Forward and Future Strategies. Now, how do we adjust the beta of an equity portfolio using futures contracts? So the formula is given by N sub F, which is equals to the target beta minus the current portfolio beta divided by the equity futures contract beta times the current market value of the portfolio divided by the futures price. So think of it this way. Your beta is currently at this point and you're trying to move it to this point, the target beta, using the futures contract which has a beta of beta sub F. So in this case, if you get a positive number, you will have to long futures contract. And if you get a negative number, that means you have to short futures contract. And of course, you cannot long or short futures with decimal values. So we'll normally round it to the nearest whole number. Now, the target return from the equity portfolio after you have entered into the futures contract position is equals to the return from equity portfolio plus the return from futures contract position. So of course, in notation, the target return would be the target beta times the current portfolio value, and the return from the equity portfolio would be the current beta times the current equity value. Then the return from the futures contract position would be the number of futures contract multiplied by the beta of the futures contract times the price of the futures. Now let's take a look at example 1. So here we have Lextron Incorporated. It's an equity portfolio management firm. One of his clients has decided to be more aggressive for a short period of time. It would like LX to move the beta on a $65 million portfolio from 0.85 to 1.05. Now LX can use a futures contract price at $188,500, which has a beta of 0.92 to implement this change in risk. So determine the number of futures contract LX should use and whether it should buy or sell futures. Now as a quick check, when you're trying to increase your beta, you will have to increase your exposure to stocks. And you can do this synthetically by going into a long position in futures contract. Now if you would like to reduce your beta exposure, you will have to short futures contract. So using the formula, we can then calculate the number of futures contracts required. So the target beta is 1.05 minus 0.85 divided by the futures contract beta, which is 0.92. Now the equity value of the portfolio is $65 million divided by the futures price, which is $188,500. So that gives us 74.96. So LX will have to buy 75 contracts. So remember to round it to the answer to the nearest whole number. Now let's take question B. Now let's say at the horizon date, the equity market is down 2%. The stock portfolio falls 1.65% and the futures price falls to $185,000. Determine the overall value of the position and the effective beta. So take note that previously we have entered into a transaction to long 75 futures contract. So we want to find out what's the overall value of the position. So the return on the stock portfolio is a loss of 1.65% on the $65 million. So that's a loss of 1.0725 million. And the return on the futures position will be 75 contracts multiplied by the change in the futures price, which is a loss since the price dropped. So the loss is also $262,500. So the total return would be the change in the stock portfolio plus the change in the futures position divided by the initial equity value. That gives us a loss of 2.05%. Now, take note here, the equity market dropped by 2%, but your overall portfolio actually dropped by 2.05%. So that tells us that the effective beta of your portfolio is now the change in the overall return divided by the change in the market return. And that gives us 1.025. So the actual beta that we observe here is lower than the expected beta based on our target. Okay, as we have, of course, this is just estimated. So the actual beta may turn out to be different than expected.